Hey folks, I welcome you to today's episode, and today we're gonna be talking about institutional reference point, understanding institutional reference point. Institutional reference point are key areas or levels, let me say, are signatures in the forex market, right? And it is also refers to as PDRAs. That's what the PDRA metrics, right? These are all the same things. And most of the commonly used name is PDRA, the ICT concept, right? Is a PDRA or institutional reference point and a PDRA are all the same thing, right? So they are key levels, these are signatures, right? Showing that what the institutional traders, which are the smart money, are present in the market. So institutional reference point, which is also PDRA, are key price levels that what smart money as an institution, these are the bank, the hedge funds, use to manipulate price movement. That's why we talked about liquidity. How are they what engineered and how are they being taken, which is a sweep of liquidity, a stab hand. These are all manipulation because the lure they manipulate traders that what that this is where price is going and then what is just a first move to then what take our liquidity and then move the other way. So these are levels that smart money uses to manipulate price movement. This level serves as well decision point for liquidity graphs, reversal and trend continuations. Understanding these points, which is the institutional reference point, helps traders, which is what an ICT trader or ICT traders to align themselves with institutional moves rather than falling into their what retail trap. So this is what edge we have over retail traders that use retail concept. We are all regarded as retail traders, but we don't use retail concept. We use ICT concept. We use smart money concept, right? So this understanding of what the PDRA metrics, which is the institutional reference point, give us an edge. Why? Because it helps us align with what the institutional moves. Because we can identify this is the footprint. We can identify that they are in the market by understanding these very particular signatures, these price levels, right? So this is it, guys. So when we talk about periodic metric, it's concise of a lot of things. First, we're gonna talk about the premium discount rate, right? So in the previous chart, you saw something discount premium, right? So here we're gonna talk about a premium and discount rate or levels. So we use what is called Fibonacci retracement. It is on TradingView, right? So we identify, we project the equilibrium, the 50% midpoint of the range, while the premium is above the 50 level, where institutional prefer to sell. So what the institution are doing, they are not buying or selling at just random levels. They are certain place, there are certain location that what they put in their order in the marketplace. For example, they want to sell. They prefer to sell at premium levels. Why? Anything above premium is cheap. It's expensive rather, sorry. It's expensive. So they want to sell at a higher price. Do you understand the logic here? They are selling at a higher price. When we talk about a discount zone, which is the discount array, it should be a zone now, right? So this is below 50% level where institutional prefer to buy. They prefer to buy when price is cheap, and they prefer to sell when what? It is expensive. So smart money buy at a discount and sell at a premium. As I said, we're gonna use what? A Fibonacci retracement. This is a tool on TradingView. And the midpoint of this Fibonacci, which is a 50% level, it refers to at equilibrium. Equilibrium is a point whereby the price is neither cheap nor expensive because it is in the midpoint. So we don't want to be buying or selling at equilibrium. Why? Remember, the institution or the smart money prefers to buy at discount and sell at premium. So in equilibrium, was it telling us the institution are not taking trade at that very particular area. So what we're doing is what we are trying to align ourselves with the institution, with the smart money traders. This is all we are doing. So that's why it's important we understand what the PDRA metrics, the institutional reference point, right? So I'm gonna go to the chart and show you this true. Uh, this is my trading view, and just want to show you Fibonacci. The way you use Fibonacci is from a swing low to a swing high. So you can see the midpoint here, which is the green line, you can see that 0.5, representing what? That's a 50% retracement, a 50% level, which is what? Here is our equilibrium. From this above is our premium, and from this below it is our discount. So what the institutions are doing, they want to buy at discount and they sell at premium. See what happened. Market went up to a discount. It went up to a premium here rather. Then you can see it moves down toward a discount. It is below the 50% retracement here. You can see the market rally up to premium and then come down, and currently it is at discount. To extend this further, let's do this. You can see currently this is where we're gonna be buying below the 50% retracement, which is what? The discount level. So this is the true, and this is the setting to the Fibonacci retracement. This is a true, this is my settings for the premium and discount array. So you can screenshot this, then you tend to um, input these settings, right? So this is what the institution are doing. From a swing high to low, from a low to high. This is our swing high. This is our low. You can see. What do you see happen? The market came down to discount array, the discount level or zone, and you can see the market begin to go up from the discount. So these two tell us what we are aligning ourselves with all the institutional traders. They buy at discount, they sell at premium. This is what this logic is all about, guys. Right? So DZ for premium and discount array, or Fibonacci retracement, guys. So we use the two Fibonacci retracement to determine where our premium is and where our discount is. Above 50% is premium, below 50 is discount. At midpoint is equilibrium. And we don't want to engage at what equilibrium level. The next PD area we're gonna be talking about is a fair value gap. So it is a concept in ICT. It stands for imbalance in price action, right? So when there's an excessive buying or selling in one direction, it leaves a gap. In the previous lessons, I outlined what an internal and external rent liquidity. We said internal rent liquidity are defined by the fair value gap. I showed you what a fair value gap is, right? A fair value gap in ICT concept refers to an imbalance in price action where the market moves aggressively in one direction, leaving a gap between the previous and the next candles. This gap represents inefficiency in price delivery and is often revisited by smart money before continuing in the original direction. So this gap I outlined to you guys, it will be revisited by smart money in the future. What is the gap representing? It is representing an inefficiency in price delivery. And price is supposed to be delivered efficiently. So when there is an efficiency in price delivery, smart money will revisit that very particular area of time, right? Here we're talking about fair value gap or fair value gaps. So in the future, smart money will what? Will revisit that very particular gap, filling, and then that's when price is efficiently delivered. And then when it continues toward the original direction. This is a bullish fair value gap. This is for bullish market, and this is a bearish fair value gap. You can see these are three candles in which the previous candle highs, the week high, and the lower of the upper one create a gap. How did you see the middle candle? The candle in the middle is indicating that aggressive move we outlined in our definition, right? That's the result where the gap is. So it is what a level, an area that what smart money will revisit in the future before market would retreat into the direction, which is either a buy side or sell side liquidity. Likewise, the bearish market, you can see here the low of that very candle and a high. That's what created that fair value gap in the bearish market, right? So price or smart money push price, they revisit this level toward efficiently deliver price, right? So that's the reason. You can see here, this is an example of my chart. What can you see there? We have a red on stop, which is what? High resistance liquidity. Right? We can call that one as a stop hand or a sweep of liquidity. Which type of liquidity? Sell side. The market went up, it created a fair value gap that is outlined with a green with a black line there. What did you see happen? What can you see, guys? What can you see there, guys? Sorry about this, guy. Just want to point it. Can you see this? We have this high here. We have the low. We have the high. It created this gap here. What do you see as the market went up? It consolidated and then what? It later tapped in to that fair value gap. It consolidated. We expand again. We went up. Created what? Another fair value gap. The market went up and then what? The market calmed down into what? That fair value gap to rebalance, to efficiently deliver price, and then what? The market rally up. This is what fair value gap is. And this is how institutional traders, which are the smart money, right, efficiently deliver price, right? So these are not random. This is not random. It is an institutional, it is an algorithm, algorithmic what delivery. You can see the moment it starting, it rally up heavily, right? That's to indicate what an efficient price delivery. This is a very short example. We can see a sweep of this liquidity of this all high. You can see how we're aligning these things, guys, from liquidity to PDR rates. If we are to drag our Fibonacci retracement, this should be our premium level. What do we see here? A sweep of this high, an all high, or reside above an all high, buy side liquidity. The market came down heavily, you can see it created this big favor lookup. The market, the price came in to efficiently deliver price, came down again. What did we see? We went up into the fair value gap, came down again, went up again to the fair value gap, and you can see it rallied all the way down. So this is how price is efficiently delivered. And one thing I just want to say to you guys is not all fair value gaps that we're gonna be filled or that it's are gonna be revisited, right? So it all comes to narrative. There's some certain criteria or condition that need to be met for this to happen, right? So all of these things in the future lessons you tend to understand, right? So this is for fair value gaps, guys. The next video area we're gonna be discussing here is order block. It is also what um as signatures, right? Indicating that what the presence of our smart money traders. So what is an order block? A simple definition of order block is a change in the state of delivery. There is a definition by Aristotle itself, right? We also have a type of order block, which is the bullish order block and the bearish order block. It is a change in the state of delivery, right? Bullish order blocks form before a strong upward move. Price is likely what? To retrace these areas before continuing higher. That's in a bearish market, in a bullish market rather. Bullish, we are trending up, which is what we are buying. Bearish, we are gonna sell, or the trend is going down. So a bullish order block should support price going higher, right? And a bearish order block should support price going down. So that's why it says bullish order block formed before a strong upward move is likely to retrace this area before continuing higher. Bearish order block formed before a strong downward move. Price is likely to retrace this area before continuing lower. We should add that support. This is what it means, or this is how it looks like. You can see here, these are this canary. We are below 50% of the what Fibonacci retracement, and we have an whole high here in a form of buy side liquidity. Remember, guys, all highs reside buy side, all lows sell side liquidity. So these are this canary sweep of liquidity here, and then what do you see here? The, this very candle that move price higher closes above this. Let me see if I can increase this for you guys. Size. Yeesh. So sorry, guys. Sorry about that. You can see um, this canary price came, and then you can see that green candle. That's representing what another block. It is a true candle here. It's not just a one candle here. It is a true candle, right? So this is so the bearish candle and then the bullish candle. You can see the bullish candle rallied up with a strong energy, and then what? It closes above the opening of that very bearish candle. This is another block. It is signifying, or it is saying, well, there is a change in the state of delivery, which is what from bearish then bullish. Sorry, let me try and rectify this, guys. Sorry about that. Okay, so you can see this array all high in a form of what? What is side buy side liquidity? The market comes down to this array, sweep sell side liquidity. You can see here we have an open high, low close. This is a bearish candle. You can see this bullish candle rally all the way up, and then it closes above here. And this is the opening of this bearish candle, and this is the opening of this one bullish candle, and then it went up heavily. It closes above. So we want to see that closure above the opening of the previous candle in a bullish market. So this is what a bullish order block, and it signifies or it says that what this is a change in a state of delivery, guys. From then what from bearish to bullish. Here we have a premium already. What is side there? No high. Buy side liquidity. The market reach out for that liquidity, and then you can see what this drop down heavily. You can see it closes. This is a low of this bearish candle. We have an open, low, high close. You can see this bearish candle closes below the low of that what bullish candle. This is what another block. And what did we define another block? It is a change in the state of delivery. That's to say, this delivery from a bullish because from all those high, the market have changed instead of delivery to bearish. from bullish to bearish. So this is why it is called what? A bearish order block. This is why it is called what? A bearish order block. This is a bullish example of an order block. You can see here. What do we see here? One thing I want to state clearly is this: an order block could be a one candle energetically, or it could be a series of candles. Here we have 1, 2, 3, and 4 candles. There's a series of down close candles. What do we see? This candle higher will closes higher. What's this telling us? What's this telling us? There is a change in the state of delivery. Remember from here, guys. We are bearish. We came, hit what a discount array here. It could be a fair value gap that was filled in the form of a discount array. We can see this order block here signifies will tell us what we have changed the state of this delivery from a bearish to an what bullish market. How do we see this, guys? From here you can see the market went up explosively, heavily, right? So it could be a series of down close candle for bullish order blocks, and for bearish a series of what up close candles. It could be one. We want to see that closure above market. We come down to that very level. We want to see it being respected. What do we see it? When we are bullish, we want to see down close candle in a form of what order block respecting price going what higher. This is what we want to see, guys. This is what we want to see. We don't want to see price violating. We want to see price respecting these order blocks until we reach our target in a form of what? In this example, buy side liquidity that's reciting above. You can see is what relatively equal highs. This high, this high. Yeah, again, that's what relatively equal highs. And what reside there? Buy side. They are also what low resistance liquidity. This and this are what low resistance liquidity, low resistance liquidity. What do we outline? When we have all of this low resistance liquidity, the market what we push, we clear this low resistance liquidity at ease. It is the world's simplest types of liquidity to target using ICT concept or using this very particular method of trading. Back to order block. A change in the state of delivery, and we want to see down close candle in a bearish market, which is an order block, to respect price going high. A bearish market, what do we see? From here, we're going up, hit a discount premium array rather up there. What do we see? 1, 2, 3. It could be what a consecutive what up close candle. Here you can see it could be a one candle, right? Let me show you an example here, guys. Look at this. This is a one candle here. You can see it closes above, market went up, it came down, and then it rallied up. This is an example of what? This type of order block where we have a huge candle. But here we have what? A consecutive of what? Up close candle. 1, 2, 3, 4. Market came down, close below here. You can see in time, price came up to that very particular levels, and then what? You can see we rally all the way down. So in a bearish market, we want to see All these up close candles, which are what? Order blocks towards support price going lower to our objective. Our objective in a bearish market is sell liquidity. This is our target, right? So this is it, guys. Next thing we're gonna talk about here, guys, is breakup block. That's another what? Institutional reference point, which is what? A period. We talked about fair value gap. We talked about order block. Now we're talking about what? A breakup block. A breakup block is an advanced price action concept in ICT trading. It occurs when an order block fails to hold and break. When it fails to hold, that means it break or it get violated. Or then act as what? Support or resistance. When the price retraces back to it. So it is a order form like order blocks are what? Price violate, but in the future it will act as a support area for price going up, and it will also act as a support a resistance level for price going down. I'm not teaching you the concept of support and resistance here, just to give you a logic of how this works, right? So we have two forms or types of breakup block. We have a bearish order block and a bullish order block. It formed when order block fell instead of price respecting the OB, which is another block, and then reversing, it break through it. Stop horn and liquidity grabs occur. The market takes out what liquidity stop losses above or below LB, and then what? In the future, it will be respected. The previous order block become a new support or resistance. As I said, I'm not teaching support and resistance levels here. I'm just trying to build a narrative regarding breakup blocks. This is how it is. You can see here the market is coming down here. We went up, came down. This order block here is expected to act as what? A resistance for price to go lower. Yes. Why? Because it is a bearish order block. What do we outline? A bearish order block, we're gonna have a bullish candle. Well, the bearish candle closes, right, below that low of that what? Bullish candle. This is what we are seeing here. That's why it said there's another block that has been violated. What it acts as support or resistance for price going up or lower. In this case, this is a bullish breakup block. This was meant to act as what? Another block for price to go lower. What really happened? It broke, went up, and then you can see it came to that other block, to that breaker, and then when it moved up. So what do we have? How do we classify or how do we say this is a breakup block? One, there would be what? A sweep of liquidity. Data discount array. What is side there? Sell side liquidity. The market sweep liquidity here, rally up, broke, is OB, which is a order block and a retrace. So we have what? From here is a low, high, lower low. The lower low, that was a sweep there. market rally all the way up, came down, and then it went up. A very short example of what this looks like. Premium array. Once the liquidity was swept, remember, to classify a bearish or bullish breakup block, first there must be a sweep of liquidity. We sweep what? A buy side liquidity here, right? These are meant to act as support for price going up. But we see we violated, we break down, and then in time we retrace back to these levels and then act as support or for as resistance in this scenario going low. This is a chart example. We went up, we're in premium. What do we see? Buy side liquidity was red. A stop hand, a sweep of liquidity occurred here. What do we see? Market heavily broke down. We outline our BB, that's our breakup block. And what do we see? Price in time came to retest and then it moved down. This is what is happening, right? We have a high, we have a low here, broke and then a retest and then rally down. So this is it for a bearish market. We see a sweep of liquidity down below here, which is what? High resistance liquidity runs. We have this. What do we see? Been violated. Price went up, came down to it, and then what? You can see it went up. Remember, guys, we want to see up plus candle supporting price going higher. In a what? Bearish market. For example, what do we see here? A consecutive this we see here. Price came down here, right, to support, and then it moves up. Came down here, right. We also have one here. You can see. So this is how these things align, right? In due time, you're gonna understand how to apply all these things. But here it is important that you know them before applying them. We're gonna build a narrative around these PDRs, how to use them, right? So this is it, guys. Premium zones. We're talking about premium and discount once again. Above the premium, above 50% is premium and below is discount. So therefore, any PDRA above 50% is called a premium array. What did we outline? Above the 50% retracement of the Fibonacci is what premium array. So whenever we have a PD array, which is either a fair value gap, an order block, or a breakup block that is above 50%, that it is in that what premium level, that PD array is regarded as what premium array. So whenever we have what a PD array that is below 50, which is a discount, that PD array is regarded as what? As discount arrays, right? It may be an order block, fair value gap, breakup block, right? So they are regarded as discount array. So that's why you can see some of my chart, you can see premium array, discount array. You can see how these things are aligning, guys. Homework, guys. I want you guys to go into your chart and identify all the institutional reference point, which is the PD array being taught in this episode. a bullish and bearish market. We talked about fair value gap, order block, and then a breakup block. These are the PDRA metrics that we discuss in this very particular mentorship program. There are lots of these PDRAs, guys. There are lots of them, but the ones I use is the one I'm teaching you guys. So I want you guys to go into a chart and identify all of these PDRAs or PDRA metrics or external reference point that has been taught in this episode, which is fair value lookup, breakup block, and other blocks. Identify in bullish market and also in bearish market. That's to say you're gonna have what? Fair value gap, breakup block, order block in bullish market. Likewise, breakup block, fair value gap, and in a order block in a bearish market. So easy, guys. Until I talk to you next, be safe, guys.